Good morning, everyone. Welcome to this week's Facebook AMS live call. Today is September 26th, and we are going to get started here with our issue paid numbers. This is week 38 for IULs. We have Faith G with 511, Aaron E with 1,039, Rodolfo G with 1,258, Rebecca C with 2,083, Jesse P with 2,438, Todd H with 3,623, Lincoln D with 5,228, Eufemia E with 5,951 for a weekly total of 22,131 issue paid IULs. Next up, we have annuities. This is annuities issue paid between September 12th and September 18th. We have Joseph B with $1,000, Shelly M with $10,000, James B with $10,000, Cynthia S with $10,964, Derek D with $16,712, David T with $24,000, Valerie P and Rynell P with a split on $25,000, Paige L with $31,679, Daniel W and John G with a split on $31,869, Tania A with $50,000, Vincent C with $55,325, Stephen F with $55,853, Elizabeth B with $65,585, Thomas K with $66,493, Thomas K with another one here for $100,000, Lucas A with $100,000, Dennis C with $101,250, Selim M with $120,000, Jaime C with $120,000, Robert R with $132,918, Linda L with $350,000, and then David A at the top issuing two annuities, one for $400,000 and one for $1 million, bringing our total for the week to $2.8 million. Stay tuned. We have our Q&A segment new to the call up next.
Hey everyone, Sean Ruggiero with Bridget Reimer. Thanks for joining us with the Family First Life Advanced Market Sales. This is our first official Q&A session for the FFL AMS. I believe we had posted on Facebook. We did a little quick pilot last week or the week before, and we also sent out an email to Family First Life agents asking if they had any questions, and we'll provide an answer. So basic concept, Bridget, tell me a little bit about what the response was this week and then some of the questions, and we'll go through them.
Yeah, we had actually a great response, especially after the email went out. I think the teaser helped so people knew what kind of questions to be asking, because really we want, even if they're basic, we want those questions because we don't cover those every week. And so having people have the chance to ask those quick snippets and get an answer instead of waiting till the next time we cover it on a training, right?
Yeah.
So we actually got a lot of good questions, a good range of questions, and we want to start with just some of the basic ones because they are simple answers, but you know the new agent doesn't know the answer yet, and so this is an opportunity to teach them as we go, every week. So
yeah, last week's question was you don't know what they don't know, right? You know, we kind of go over that stuff, but we have new agents all the time, and so I think this is, if you're out there and you feel like, gosh, there's a really basic thing I don't know, ask it, because that's
we actually get multiple. I mean, there's 5 agents who ask the same question, so you're not out there by yourself asking those questions, and so I think that helps just bring light to those and not feel inadequate by asking them. We want those questions so that we can help you and get those answers. So we have 3 picked out for the week. I'm going to ask them and let Sean answer for us. The first one is an IUL question from Mary Ann, and it was, is there a way to set up a policy where the beneficiary can have both the cash value and the death benefit when the client dies?
Okay. Great question. And the reason it's a great question is because it's come up historically over and over and over again.
It can be confusing,
If we look at an index universal life policy, it's going to have a bunch of columns, okay? And those columns, at the end, they have death benefit and cash value, okay? And we get that question a lot. Do they get both, right? No is the answer. Now, before we just say no and move on, let me explain that a little bit. Death benefit, this is a life insurance policy, an index universal life. Even if it's structured to build massive cash accumulation, and in some cases the cash value would be equivalent to the death benefit, it would be the same. The death benefit is what everything is driven off of, okay? So the death benefit is what passes tax-free to whoever beneficiaries there are, and there can be multiple beneficiaries. The beneficiary can be a trust. It avoids probate, all these great things. That's the death benefit. The cash value can never be higher than the death benefit, but it can be lower. You do not add them together. The cash value is how much of that death benefit you can take in cash. Now, if there's a small discrepancy, normally, Bridget, that's the difference that needs to be in the policy so the policy doesn't lapse. So you can take out, if there's $1 million death benefit and $980,000 of cash value, it's not 1.98 million that you have, it's 1 million, and you can take out $980,000 of cash. The remainder is in there to make sure that the policy premiums can be paid. Now, one litmus test, and if a client ever says, because I've actually had it before, oh, well, I don't get both. You can do some math and kind of resolve that. We had a training scenario where we talked about an IUL that was solved for death benefit, $250,000. The person put in $150,000. So they have an ROI in there. It's a very good ROI, return on investment, right?
Yeah.
Hey, I'm going to put in $100,000 and I'm going to get $200,000. This is kind of a made up scenario. If someone says that they want the cash and the death benefit, well, so would I. Like Sean Mike says, I'd like to slam dunk from the free throw line too. It's not going to happen. It's an inordinate amount of money. So the ROI on an IUL that you get from just the death benefit or even just the cash value, based on the premium you put in, is always going to show a return.
Right.
The return is good enough. You can stand behind that. And if you do the math on it, it's probably unrealistic to get a return that's so good that it's double what that is, meaning don't add the cash value and the death benefit. So
right.
There's your answer.
So yeah, and so the question, is there a way to set that up and make it possible? The short answer would be no then. We cannot set that up in any sort of way.
Yeah. Now, we can set up where death benefit is the priority and cash value is lower and your premium is lower, or we can set it up to where death benefit is not a priority and you want your cash value to be as high as possible, and more of your premium is going to that.
A lot of flexibility.
But nothing to combine the two. That's a misconception.
Yep, perfect. All right, second question. We have an annuity topic here from Joanne, wanting to know if annuities, so it sounds like on this one she's actually familiar with the IULs. It's the annuity side she's not, and she wants to know if annuities come with a 0% floor, just like IULs.
Right. Yeah, great question.
Yeah.
IULs, 0%. Some IULs, Global Atlantic, 2% guarantee. Okay. Annuities actually offer very similar to IULs. They offer a floor. 0% is the generic floor, meaning a fixed index annuity will make sure you never lose money. So 0%. Some fixed index annuities, such as the legacy annuities underwritten by Americo, have a 1.6% guarantee.
So that's the floor.
That's the floor, yeah. So great question. Very similar to IULs. There is a floor. That floor is going to range somewhere between 0 and 1.6%. And those are subject to change, but it'll never be below 0. Bridget, there is a new product. It is a securities product. We do not sell it, but you might run into it. It is the replacement of the variable annuity. It's called an equity-linked annuity, and it offers minus 5% or minus 10%. It actually offers losses, but it'll stop your losses. So
the floor is actually a negative.
The floor is a negative, that's right. Fixed index annuities, the floor is always 0 or better.
And that is what we sell.
And that's what we sell, yeah. So I just mentioned that because they're brand new, they're just starting to be sold out there. I actually think for the industry it's great. It's a better product than the variable annuity.
Right.
It's not what we offer. I love what we offer, and it competes very, very well with that. But just kind of an idea. They do exist, yeah.
Awesome.
With fixed index annuities, though, your floor is 0 to, say, 1.6%.
Perfect, thank you. Last question for this week is going to be another annuity from Matt D. And he just wanted to know if we had a quick example or verbiage that we can explain how insurance companies make money in IULs and annuities, because as we know, they're such great products for the client.
Yeah.
How if there's no fees, if there's no penalties, how are these companies possibly making money? We get this question a lot, so I love this one. I'm going to let Sean take it from here.
Yeah, that's the number one question I receive from clients.
Yeah.
Is well,
too good to be true.
Too good to be true, and how do you actually make money? We did a video, an in-home video that you all, if you haven't seen it or you need to see it, email annuity@familyfirstlife.com, and someone from the staff can send it to you. But in that video, we talk about really explaining the surrender schedule. Okay, now I'm answering the question here, but I want to make sure it ties to the idea that something can't be too good to be true. How can something offer a bonus, right? And I'm talking about a standard fixed index annuity like the Performance Elite. It offers a bonus. It offers upside potential better than a CD or a bond traditionally. And no downside and no fees.
Yep.
Does that really exist? It absolutely does. It offers that because of two things. One, it has a surrender schedule. It limits how much money the client can take out. That's how annuities work. They limit how much. So there's some predictability. They know that they can invest this for periods of time, be it 5 years, 10 years, 15 years. That allows the annuity company to pool assets. Okay, so this is what is called fixed asset management, right? So they go out and they say, all right, we have this sum of assets. So they have your annuity and this client's annuity and all these clients' annuities, and they pool $10 million together. And now they go out and they try to get the best return on that $10 million. That falls within, don't let this confuse you, something called the NAIC guidelines, okay? They can't put it in very risky assets. They have to actually keep a certain percentage in investment grade bonds normally. So they go out and they go to companies like General Electric and they say, hey, your bond is currently giving 3.5% and it pays a coupon twice a year. We want 4% and we want to get paid quarterly or monthly. But because they have $10 million, they can negotiate over the counter. So that's called private placement. They pool these assets together and they take that money and they go with private placement and they get the best deals that they can out in the market. Now, what do they do with that? Let's say that they can go out and get 8%. Okay? 8% through all their various investments, 8%. They're going to take, and this is just rough numbers, this is hypothetical, they're going to take 1% and they're going to put it in the mortality pool to help pay for people who are living too long, guaranteed income for life, regardless of where your principal's at. And then they're going to take 3.5% and they're going to keep it in 3.5% and they're going to give it to the client. And that's really how a fixed annuity works. The only difference between that and a fixed index annuity is that a fixed index annuity, instead of giving you that 3.5%, because what was our question we just had? What's the guaranteed floor? Right. Usually 0. Right. Instead of giving you 3.5%, you elect to have that 3.5% purchased into something called options. And that's where you get these participations in the market. So you're indirectly invested in it. So the other question we get, which kind of accompanies this, is how are they making money? Well, they're making money by having this restricted in the surrender schedule. They're making money by investing in very safe investments, but doing it on a private placement with using leverage of numbers. And then they're taking some of that money and they're investing it into options. And if those options pay off, there's a multiplier on it. And that's where you get some of these double-digit returns because those options have a big hit. So that's the basics of,
Does it go with the idea of making money with you, not off you? Like
actually, and I'm glad you bring that up. Yeah, because if we look at traditional financial advising, and I use this example, if XYZ brokerage says we're going to manage your money for them, they have every intention of making money for you. They want to do a good job. I mean, it's not like there's evil people out there. They're trying to help you out. But if they say, here's the suggested portfolio that you should invest in, do they then take their money, invest it, and give you a high five and say, let's hope this works?
Let's do it. Yeah.
Yet they have Super Bowl ads and commercials and marketing and drive nice cars, right? They do it through fees. Whether those fees are charged directly to the client or whether they're fees that are inside the products themselves, load fees, deferred load fees, 12B1 fees, things that oftentimes clients don't even know about. That's traditional financial investing. Is it evil? No. It's different though. And ask your clients, do you want people to make money off you or do you want them to make money with you? And that's the whole idea of annuity companies and insurance companies. Pool the money together, go out and find private placement investments. Sometimes they give fixed returns, sometimes they buy options for fixed index annuities. But at the end of the day, if they win, you win, and vice versa.
Yeah, awesome. Well, that wraps up our questions this week. You guys, these were great. Keep them coming because we do want to try to add this segment to help you guys out every week. So the more questions we get, the longer we can keep this going. Thanks.
Thank you. Hey everyone, Sean Ruggiero, Family First Life Advanced Market Sales. Thanks for joining us. This is a really good presentation we have to hear today because it has to do with today and today's market environment for investing. And when I say investing, I'm specifically referring to people who are in retirement or getting ready for retirement. So the question is this: what are my investment options in this market? What do I mean this market? All right, we're going to evaluate that here in some detail, but the overnight federal fund rate has been dropped again, kind of unexpectedly. Corporate yields, bond yields are extremely low. going to talk about that a little bit. And what does that mean? That means if I want to do something that's a conservative investment, like a classic retirement investment, laddering bonds, right? Buying bonds, CDs, things of that nature, the yields are extremely low. I actually read an article that in Denmark, there's negative interest rate mortgages. They actually pay people to borrow money from the bank. That's how low interest rates have been. So this is an international thing, not just a US thing. And then what about stocks, right? That's one of the reasons why stocks are so overpriced right now. Overpriced, is that my opinion? No. I'm going to show you a statistic. Does that mean we're recommending stocks if we're not a licensed securities agent? No. We are observing the landscape and evaluating what people's options are, and also fulfilling our quest to have some knowledge on what the options are so we can understand why fixed index annuities could make sense. So, what are your options? There's three basic options for someone who is in retirement or near in retirement. They can invest in the stock market, they can buy CDs, or they can invest in bonds. All right? Something we get a lot of is, well, what about ETFs? What about mutual funds? It's a good question, but really a mutual fund is built of certain things. So you can have bond mutual funds, you can have mutual funds based in certain stocks, same things with ETFs. At the core of everything, we're looking at three basics: stocks, CDs, bank products, and bonds. So that's what we're going to evaluate. Those are your three options. I want to start with stocks. Okay, we're going to dissect two things here. We're going to look at the S&P, the Standard & Poor's 500 performance. That's the top 5 companies in the U.S. based on capitalization or revenue. The S&P 500 one-year performance, and then something called the Shiller ratio. Okay, the Shiller ratio. So here's why I'm going through this. We are in the midst of the longest extended bull run, right? Bulls charge up. The longest extended bull run in market history. It has gone 10 years now, okay? Essentially from November of 2009, after the big plummet of 2008, from November 2009 till now. In 2018, we were level, maybe even lost a little bit, but we have bounced back in 2019 to what is the highest that the S&P 500 has ever been in history, reaching and even eclipsing the 3,000 mark. But what I want you to look at is the most recent year. Start here. Come down, back up, down, back up. There we're at 3,000. And now we're just bouncing around at the top. What am I pointing out? I'm simply pointing out that the S&P 500 has reached the highest it's ever been after a 10-year bull run, and it is now staying level. All right? The last year is quite an indication of where the market is. Can't look at the last 10 years. We've got to look at the last year and say, all right, what's next? Not sure. But let's look at this. This is factual data, factual information. There's something called the Shiller ratio, And what it does is it looks at the price based on the earnings of stocks for the S&P 500. So we're going to exclude the dot-com bubble. The dot-com bubble went way up here to where people were paying almost 40 times the earnings for stock in a company. Why am I excluding that? It was the dot-com bubble. It was exacerbated. It was way too high. So I'm excluding that because it really is an outlier. It was something where people were investing in companies that weren't even making revenue, but they had a scare that the dot-com craze was going to take over the world, so people were over-investing in it. So what I'd like you to look at is here, where we're at right now, about 30 times earnings is what you're paying for stocks. And we're at an all-time high, 3,000. That's now the highest it's ever been since the stock market crash, what they call Black Tuesday, way back in 1929, okay? Now, am I predicting a stock market crash? I'm not, all right? And if I was, it wouldn't matter, meaning no one knows what the market's going to do. But let's look at facts. The S&P 500 over the last year has stayed level, and stocks are more expensive than they have been in history if we exclude the dot-com bubble. So what that's telling me is that stocks will do one of three things. They'll either continue to stay the same, stay level. They'll either go down or they'll go up. Now that seems like an obvious statement, doesn't it? It's not what I'm trying to do, is say something neutral and obvious. I'm saying one of those three things would happen. But if we look at the factors of how expensive they are
and what the market's done over the last year, conclude for yourself. Don't give advice on something you're not licensed for. As an investor yourself, what do you think is going to happen? What does the client think is going to happen? Okay? Well, let's take a look. Let's continue now with bonds. All right? So if we feel that stocks are overpriced, and the statistics show that, if we're scared, if we're nervous, and as retirees, we should have a healthy amount of fear. As retirees, if we feel that the market is going to go down because stocks are overpriced and because the market has been bouncing up and down at a level stasis for about 1 year now, maybe we want to invest in bonds. Bonds are a much more traditional, safe, and conservative investment for retirees and pre-retirees. Well, I want to examine two things. The Moody's corporate bond yield history, not just how much bonds have yield, the history of that, and the 10-year T-bond history. The T-bond is considered something that is a risk-free investment. So if a T-bond can get you 1%, 2%, 3%, it's considered risk-free because it's backed by the good faith of the U.S. government, so it's not going to go anywhere. So if they say they're going to pay you 2%, they're going to pay you 2%. But here's what I want to point out. When we invest in bonds, because that is an option, all right? The bond, let's say it's a 10-year treasury bond, okay? So it's not going to collapse, it's not going to implode, it's going to pay you what it's going to pay you. But what is the coupon rate on it? Well, back in 2014, it was getting up close to 5%. That's not bad, right? I'm going to earn 5% on my money over the next 10 years. But then in 2015, it dropped all the way back down to about 3.65%. Then back up, down, up, down, up, down. And now we're covering down in that, for a corporate bond, that low 3% range. All right? Now, what about T-bonds? What about government bonds, which make up a huge portion of people's investment portfolios when they're in retirement? Why? Again, I'm reiterating this, because they're safe. Because they're backed by the federal government. So if you have a T-bond or a T-bill, you're going to get paid. But look at the performance of this. Back in the 1980s, almost 16%. Crazy, right? Fighting a lot of inflation. Now it's come down, and now here today, less than 2%. So why am I pointing this out? A corporate bond yielding 3%, a T-bond yielding 1.8%. Because if you invest in bonds, then you are invested in that bond for 10 years. So if I buy one today that yields 1.8%, it's guaranteed, it's safe, but now I'm locked into that coupon rate for the next 10 years. So the last one I want to examine is CDs, certificates of deposit. Also safe. Yes, we could talk about the FDIC limit, or banks have they're more likely to go insolvent than, say, an insurance company. We don't sell, nor should we plan off of hysteria and extremes. If you buy a bank CD, it's a very safe investment, and it is backed by the FDIC up to $250,000. But again, the problem is the yields. So if we look back in 1984, CDs could get you almost 12%. And what has that done over history? Brought us to the all-time low for CDs. So we have CDs now that are yielding under 1%. And that's for a 10-year CD in many cases. 5-year CD, a 1-year CD, a 10-year CD, hey, I'm going to get 1%, 1.5%. You can't live in retirement with making that type of money. So, what are the options? Fixed index annuities. Those three things that I showed you before, each one of them, I tried to factually point out what the potential problem could be with that. All right? How does the fixed index annuity solve some of this problem? Okay? And are fixed index annuities giving the highest guaranteed minimums right now? No. They are still a reflection of the market. The market is down right now when it comes to investment options, especially for retirees. So a fixed index annuity is going to have lower participation rates right now in September, October of 2019 than it did just a year ago. It's going to have lower bonus rates. But the cool thing about fixed index annuity is that every year it resets and it can grow. So if the yields start to grow, unlike a 10-year bond that you had locked in, the fixed index annuity will now grow. That's one of the cool things about fixed index annuity. So let's talk about this from a stock market standpoint. What if the market stays the same? Remember we talked about it bouncing around? What if it stays the same? What if it goes up? What if we're wrong? This thing goes up like crazy. What if it goes down? Well, here's what it looks like. If I had $200,000 invested in the market, okay, just in something sort of balanced, like an S&P fund or maybe something more conservative, 60-40 stocks, bonds, let's say it went up 2%. I call that staying the same. It goes up 2% basically because of inflation, but it basically stays the same. Well, if I used, and I pulled these rates from an actual S&P cap and participation rate product that we do have, fixed index annuities. This is an actual product that we have as of this date. The cap is 5.25%. So if the index went up 2%, you would capture all of it, and you would get $4,000 credited to your annuity. If you used the participation rate, you would capture half of it, or $2,000 credited to the annuity. Now, what if the unlikely, this is my opinion, the unlikely scenario where the market goes up another 15% next year, okay? If that does happen, and maybe it's going to happen because institutions need to invest and there's no money in bonds, so they just keep piling on these stocks. And we go from 30 times earnings to 35, maybe to 40, and surpass the dot-com bubble. In my opinion, that would be a little scary because you'd be way overpriced on stocks. But let's say it goes up 15%. Well, you're going to capture 5.25% of that. If you chose a cap, now most people choose a participation rate, so you would capture half of that, or 7.5%, which is $15,000. So do you capture all of the upside when you use fixed index annuities? No. They're not designed to beat the market, all right? But without having to time it correctly, without having to think about what to buy, what to sell, when to buy, when to sell, you're going to capture it, whether you use the cap or the participation rate, when the market goes up. Now remember, it is an insurance product. So what if the market goes down? What if yields start to climb and that 30 times earnings purchase, that Shiller ratio, reflects what's going to happen? Because remember what happened in all those scenarios where the stock price went way up? What happened right after it was up? It went way down. Am I predicting some sort of recession or a stock market crash? Nope, I'm not. I'm just saying it could happen. And if you think it can't happen, you're fooling yourself, because it definitely could. And if you're in retirement or preparing for retirement, can you handle that sort of drop in your retirement portfolio? So if the index went down just say 10%, it went from 3,000 to 2,700, and it's actually been bouncing around that range currently over the last year, you lose zero. You lose no money. So it's an insurance product for a reason, because it comes with insurance, the insurance that you won't lose money if the market comes down. So you're essentially able to avoid these super low yields, to offset that by have some upside or even high upside potential in the market, and have the security that if you're wrong in the market, you won't lose any money. So what is this worth to you? If you're planning for retirement, if you're in retirement, remember this. Unlike buying fixed 10-year bonds or CDs, your participation rate grows as the economy grows and recovers, okay? You eliminate fees. We didn't talk about in this presentation here, but you eliminate fees. Doesn't that feel good knowing that you're not being charged fees? You eliminate market risk. That's huge. You eliminate market risk. So if we are in a situation where the market comes down, you don't have to participate in that down market. And you're going to eliminate worry. You won't stay up at night thinking, gosh, I'm stuck in this 10-year bond that's going to pay 1.8%. I'm stuck in this CD that's not even beating inflation. Or I'm exposed to the market, and I wonder if tomorrow morning the market's going to come down. Or I wonder if next month's going to be a rough one. Or I wonder if 2020, if the market's going to fall. Because none of those scenarios affect you. You have some insulation, some insurance, if not complete insurance when it comes to market risk, when we use an FIA. So participate in the upside, eliminate fees, eliminate the downside, and eliminate worry. If you have any questions, please email info@fflams.com. Thank you.
Hello, this is Jay Rosencrance from Athene. Today we're going to talk about one of our FIAs that we launched last year, and that is Athene Agility. At Athene, we feel like we have products that cover any need that a retiree or a pre-retiree has getting ready for retirement. The great thing is that they all offer protection against downside. The whole structure behind a fixed index annuity is that you get to participate in the upside of the market, but you don't have to worry about the downside or the losses in the market, which is great for clients that are getting old and don't want to have as much money in the market and are squeamish about the volatility of the market. So our go-to FIA for income is the Athene Ascent. Our go-to FIA for accumulation is the Athene Performance Elite. And what we're going to talk about today is our go-to for legacy, which is Athene Agility. Though Athene Agility, as you'll see, is very strong for income as well, just in a different way that Ascent is. And it can be strong for accumulation. So we'll walk through how the Agility works, talk about the fact that there's no fee on Agility, which is awesome, and then go through a sales idea to show how it can apply to your clients or to your prospects. So we're going to talk about the benefit base that's available on the Agility that can be used for either income down the road or as a death benefit. We'll talk about some other features to the contract to include a confinement doubler, again at no cost to the client, to help hedge against the cost of health care or nursing home. So how does the benefit base come together? There is a 25% bonus that is credited immediately to the Agility contract. So there's no premium bonus on the Agility contract. So if we used as an example a client that put in $100,000 on day one, their account value would still be $100,000 because there's no premium bonus, but the benefit base would immediately be $125,000. Then every year, that benefit base grows based on 175% of the interest credited to the contract. So let's go through an example. Let's say we use $100,000. So day one, that benefit base is $125,000 due to that 25% bonus. And let's say that in year one, they earned 4% interest on the strategies that they picked. So the account value goes from $100,000 to $104,000. But the benefit base actually grows by $7,000 because you get that 175% multiplier on the $4,000 of interest. So we tack on that $7,000 of interest onto the $125,000, and at the end of year one, the benefit base is $132,000. So they've earned 32% interest on the benefit base in year one alone. But then every year going forward, that benefit base will continue to grow at 175% of the interest credited. So just an amazing way to grow that benefit base. Like the Ascent and the Performance Elite, we offer a wide array of both capped and uncapped strategies. The uncapped strategies are through our partners at Janus, as well as BNP and Morningstar, and those are offered in either one-year strategies or two-year strategies. So what a lot of agents will do is put some of the money into a one-year strategy and some of the money into the two-year strategy. Then at the end of the first year, they can show the client that they had some interest earned, but the two-year strategies offer a higher participation rate. And so at the end of the first year, you can move all the one-year strategies into the two-year strategies. So going forward, you're going to get interest every year, but at the two-year strategies, which offer the higher participation rate. So you can turn on income in Agility after 10 years in the contract. So if you've been in the contract for 10 years, you're eligible to turn on the income. And remember that income is based off of the benefit base that has been growing every year based on the 25% bonus and the 175% of interest earned. When you actually get into the income phase, the only option is increasing income. So you're going to be able to hedge against inflation in retirement because you're going to get a pay raise every year or every other year, depending on whether you're in the one-year or the two-year strategies. So two things are happening. Let's say that we have $10,000 in guaranteed income the first year you turn on income, and you earn 4% interest in your index strategies. Well, that means next year you get a 4% pay raise. So next year your guaranteed income is $10,400, and you'll get a pay raise every year based on the amount of interest that you earn. So, or every 2 years if you're in the 2-year strategies. And that number can never go down, it can only go up. And you'll continue to get those pay raises even if the account value goes to zero. So just an incredible offering to help hedge against inflation. Two things happening. One is the benefit base is going down every year because you're pulling money out. However, we still, even in the income phase, offer that 175% multiplier on the interest earned. And what that's doing is making that income last even longer than it would without that benefit. So I mentioned the enhanced income benefit. If a client has to go into a nursing home, we'll take that guaranteed income that they have and we'll double it. And we'll double it for as long as there's money in the benefit base. And the account value. Once the account value goes to zero, then we'll revert back to the initial amount. But those payouts will increase every year because you're getting increasing income. So you can stand to get a substantial amount of money in a period of time, whether it's 2 years, 4 years, 5 years, 6 years, however long it is until the account value goes to zero, to help offset the cost of nursing home care. So we mentioned that benefit base can be used for either income down the road in 10 years, or it can be used as a death benefit. And so if someone put in $100,000 at age 60 and just let it grow for 25 years, let's say it grew from $100,000 to $350,000 because of that 25% bonus, as well as the 175% of interest earned. Well, if the client passed away, the beneficiaries would get that $350,000 in its entirety over a 5-year period. So you get the benefit, 100% of the benefit base over a 5-year period. Or if the beneficiaries wanted a lump sum, they could take the account value, which wouldn't be nearly as high as the $350,000, but they could get it as a lump sum versus taking the money over the 5-year period. So you have the option of doing either. So Agility is available in all 49 states, not available in New York. We write it up to age 80, and the minimum premium for Agility is $10,000. It's a 10-year surrender charge on the contract, so it's called the Agility 10. So just to recap, you can turn on income in 10 years using that benefit base, and when you turn on income, those payments are going to increase every year to help hedge against inflation. The growth is based on the growth of that benefit base is based on that 25% benefit base bonus hit that's immediate when you buy the contract, and then 175% of the interest earned every year grows that benefit base over time. And then something very unique to Agility is the fact that the liquidity, not unlike our other contracts where you can take 10% all years, including year one, but on Agility, it's 10% of the initial premium as opposed to 10% of the account value. So if a client is looking for predictable cash flow before that 10-year point, you can use that based on the 10% of the initial premium. So if a client was looking to fund a life insurance policy, or they were looking to replicate Social Security payments because they wanted to push Social Security out to age 70, the Agility is a perfect tool in order to take withdrawals using the 10% of the initial premium each year in order to do that. So we're going to go through an example of a way that Agility can really help with clients out there, and this is thinking about clients that have to fill a gap that happens when one of the spouses passes away and takes some of the income with them. And so this is Jay and Susan. Jay is 67 and Susan is 62, and they both get a Social Security payment. Jay's is higher than Susan's, and Jay also gets a pension payment. So A couple of things would happen when Jay passes away. One is his pension gets cut in 50%. So right there, Susan is getting half as much money from that pension plan. Susan would then step up and assume Jay's Social Security, but she would lose her own Social Security. So the mixture of getting the pension cut in half plus losing one of their Social Securities creates a huge gap for the surviving spouse. The Agility can help fill that gap. So let's say that at 67 and 62, they put $100,000 into the Agility, didn't take any withdrawals, and just let it grow. They wanted that benefit base to grow so that they could either use the death benefit or turn on the income when Jay passes away in order to overcome that surviving spouse gap. So let's see what that looks like. Let's say that Jay lived for 15 years until age 82, and he then passed away at age 82, and if Susan assumed the contract and turned on income, her income at that point would be $26,881. And so that's going to cover the roughly $25,000 gap that they had from the reduction in pension, as well as the loss of her Social Security income. So as you can see, every year then after that, that income is growing, or in this case, every 2 years, because they're invested in those 2-year strategies. So if Susan then lived from 78 to 90, so 12 more years, you can see that her income has grown from $26,000 to $64,000. And the amount of total withdrawal she's taken over that 12-year period is $579,000. Now, there's a chance that Susan may not live till age 90. What if she passes away earlier than that at age 86? Well, her income had still almost doubled from $26,000 to $48,000. She's still taken $340,000 in withdrawals. Remember, we only started with $100,000 in this contract, and yet there's still a death benefit that remains of $118,000 that she could pass on to her kids or to whoever her named beneficiary was. So a great way for a client who's looking to close the gap for a surviving spouse that's going to be losing a lot of income from perhaps a pension or from losing Social Security income. Agility can be a great way in order to fill that gap. So if you run into a client that's looking to pass on money to their heirs, they don't want to pay any fees, then Agility is something that you want to consider. You can reach out to the Family First Life folks at Annuity@Family First Life, or call the Athene sales desk, and we'd be happy to put together a proposal for you for your next Agility client. Thanks, and appreciate your time.
Hey guys, Frank Eufemia here, Family First Life National, and honored to be on the AMS training call. Gosh, what a huge tool that we have here to utilize to help new agents and seasoned agents better utilize what we have in place as far as annuity goes. If you're not using it, you're nuts. If you're not on this call weekly, you're crazy. If you're not using it, ask a specialist, you're crazy. The financial inventory, everything that we have put in place to help you guys as agents find annuity money, convert it into applications, which converts into money in your bank account. It's also very simple to use, and I think a lot of times as new agents we get a little bit worked up and concerned about how we appear in a home when we're going to write an annuity. Do we sound smart enough? Do we know enough? Are we going to get shot down by somebody who has a financial advisor? Are we going to have someone that's got a little bit of knowledge of how the market works, and are they a little more knowledgeable in this than we are? And those are very legitimate concerns as a new agent. I get it. But what I can tell you is, with all the tools we have in place and some of the things that I just mentioned, and this call being one of them, gosh, it's annuities to me are they're easier than selling mortgage protection. Not much gets easier than selling final expense, because we're all going to die, and you're either going to get buried or cremated, and both of them cost money, and somebody's going to be responsible for paying that bill. But when it comes to mortgage protection, sometimes you need to know a little bit how loans work. You need to know amortization schedules if you're going to do paying the house off early. So it's sometimes people get overwhelmed with that as well. But when you look at an annuity, and to keep it very simple, I think the reason I've had a degree of success selling annuities is because I've simplified my appointments. I've simplified how I explain it to people, and I've simplified the products to make folks feel comfortable and understand what they're getting into. And when you listen to Sean Ruggiero train us, and he does his annuity presentations at conference and these sales conferences, and when he's on here training us, he's extremely intelligent and does it work well? Yeah, absolutely. But a lot of us don't have the background that he has, and a lot of us don't know what he knows. And it doesn't mean that you can't do exactly what some of these top producers do. I mean, you look at Matt Walker, who's been selling insurance now for 3.5 years, and was in the top 5 annuity producers last year. I think he was number 2 or 3. He was a personal trainer. And you go, well, he went to college, played baseball in college, so he didn't major in stocks and bonds, mutual funds, and finance. But he's an intelligent human being, but he's not a genius, and neither am I by any stretch of imagination. I think what y'all got to realize is people just want to believe in what you're selling, and they want to believe in what you're telling them. They want to believe in the product that you're offering, and they want to know that at the end of the day that they're safe. And that's really what most, Matt Smith trains on this all the time. The biggest fear of baby boomers nowadays is outliving their money. And if you think about that, it's a fear that most of the people that I've ever sat with that I write annuities on goes over. And some of them don't let you know it's their biggest fear. But most people that I sit with, do not have $3, $4, $5, $6, $7 million sitting in an account where they can take $200,000 a year or $100,000 a year and not have to worry about their money running out. Most of them have anywhere between $50,000 to $750,000 to $800,000. They're not sitting on a ton of money, so the fear of them outliving their money is very real. But for us, for what I've also noticed is that another one of their fears is being lied to. And so when you think about sitting with somebody for an annuity appointment, okay, and the first thing you got to do, and there's all kinds of trainings on how to ask the golden question: what do you have that acts like life insurance? Whether it be a 401k, 403b, TSP. Once someone goes, well, I have a TSP, and you find out how much they have in there, and you're moving on because it's a mortgage protection appointment. That stuff's kind of simple to do. But when you get back in the home, what you got to try and realize is these folks are normal people just like you and I, and it's their life savings. So whether it's $20,000 of coverage, or $20,000 of savings, or $200,000 in savings, it's a lot of money to them, and it should be a lot of money to you. And to most of y'all watching this, 20 grand's a lot of money. If I laid it on the table and said you want it, nobody would turn it down because it's a lot of money. If I laid 2 pennies on the table and asked you if you wanted them, you would probably walk away. So 20 grand's a lot of money, but regardless of what the amount of money is, you gotta act and treat them as if it's a ton of money, and it means the world to them, because it does. So a couple pointers on what I do to present annuities and how I think I'm able to get folks to trust me is I always let them know that I'm on their side. Regardless of what the situation is, I let them know I'm here to help you. I'm here to make sure that whatever you need to have happen, we can put you in the best product to make sure that exactly what you want to have happen can happen, or give you the best chance of what you want to have happen. As opposed to if we have our money in the market and they want their money to last for the next 25 years, and they want to leave us X amount of dollars to their beneficiaries. Well, if it's in the market, and the market drops for the next 5 years, there's no guarantees that's going to be here for 15 years, let alone 25. but I'm very simple when it comes to explaining it to them. And I let them, like I said, I let them know I'm on their side. I let them know that I can promise them a few things. One thing is I'm going to be 100% honest with them no matter what, whether they're going to like the answer I give them or whether they're not. I'm going to be honest with them. And if I don't know the answer to the question or a question that they ask me, I will let them know and I'll call and get the correct answer. So I'm not going to answer a question that I'm not sure of. And I'm not going to tell them anything that's not true. And as cliche and corny as that may sound, people like to hear that, because if you read any news or you watch the news or hear anything about people's retirement accounts and things that go on, or nightmares with this agent, or crazy stories or lies that have been told by this advisor, it happens on a daily basis, and these people have heard about something in the past. So you want to try and put their fears to rest a little bit. You want to bring their guard down just enough so that they're not sitting there questioning whether or not you're telling them the truth, but they're actually listening to what you're telling them and absorbing it, and then they can verify. See, my biggest thing is, I always tell them, listen, I'm not expecting you to trust me. Tom and Mary, we met last week and I helped you out with your mortgage protection, and now I'm back a second time. This is the second time you met me. I'm not expecting you guys to trust me just yet. I just met you. It'd be a little bit weird if you trusted me like that. All I ask is that you allow me to earn your trust. And what I mean by that, Tom and Mary, is I'm going to go through what these plans can do for you, the benefits to them, as well as the pros and the cons. And then I'm going to ask you to verify everything. So when I tell them that if we put you in a product that is not an income annuity, let's just say it's a Performance Elite 15 or it's just a cash annuity, I go, hey, so this plan is a 15-year plan. It's got a surrender charge. That's the downside, is liquidity. The insurance companies are going to guarantee you're never going to lose any money. But the only way they can guarantee that is if you agree to leave the money in this account for a period of time. Now, if you leave it in the account for that period of time, you can take all you want. But again, if you haven't read the article that Ruggiero put out, I want to say 4 or 5 years ago, about how qualified accounts have built-in surrender charges. It's an article you need to read because it's very informative. But you go through what the pros are, no caps. So this plan can give you exponential growth potential. So if the market's up 22.5%, what Athene does is they withhold the first 1.5. And you're going to get credit for, if it's 22.5, you're going to get credit for 21% of that. There's no caps on that. There's no risk. If the market's down 6 points, you're not going to lose a dime. And Tom and Mary, if you take the normal Performance Elite 15 without the extra 5% liquidity rider, there's no fees. So your money's being managed. They're not charging you a fortune to manage it. They're eliminating all the risk. They're giving you growth potential, and they're guaranteeing protection from market volatility. Does that all make sense? See, to me, that's not very complicated. It's a very simple deal. And I typically draw a step system. Your market's going to do, your money's going to do one of two things, Tom and Mary. It's going to go up or it's going to stay the same. As opposed to the market that goes up and down, you're just stepping up to where you need to go. And you draw it out. People are visual. But it's a simple drawing that allows folks to understand exactly how annuities work without you having to seem like you're a genius or that you've been through 200 hours worth of financial courses to understand this stuff, because it's just really not that complicated. So guys, I hope you're using the tools that we have in place. I hope that you're using Ask a Specialist, that you're talking to your managers, that you're reaching out to some of the top annuity producers, picking their brain. But most of all, I hope that you all are asking the golden question at every single appointment. What do you have that could act like life insurance if you were to pass away tomorrow? IRAs, 401ks, TSPs, 403bs, money out of the bank, CDs. What do you have that could act like life insurance? That's where it all begins, guys. If you don't ask that question, you won't write any annuities. So hope this helps, guys. And as always, pleasure to be on here. Thanks, Sean, for having me on. Appreciate you guys. Bye.